is Chris Bosey and I work for Evolve Home Loans. I talk to realtors and borrowers all day, every day. Today we're starting a two-part series about credit. Understanding what your credit score is, how it's calculated, what does it mean, and how does it impact you. So let's talk a little bit about what credit is to begin with. First of all, it's a tracking system of a consumer's spending habits, how they borrow money and how they pay back money. But it doesn't just include credit cards. It includes things like your home and your car loans. It does include your credit card payments, but also things like insurance premiums, rental payments, utilities. Credit scores demonstrates a person's responsibility and reliability. And you might not know this, but employers will often run an applicant's credit score as part of the hiring process. So let's talk about the 5 key components that make up a person's credit score. The biggest one, at 35%, is your on-time payment history. It doesn't mean you have to pay your credit cards off in full every month, but what it does mean is that you have to make on-time monthly payments consistently every month. The next thing, at 30%, is the amount owed to creditors. So every creditor has utilization. So the magic number is 30%. It's the relationship between the amount that you have available to use and the amount of credit that you are using. Anything over 30% will impact you negatively. If you keep it under 30%, it'll impact you positively. The next thing to consider at 15% is the length of your credit history. How long have you established a credit score? Another thing to consider at 10% is the credit mix and types of credit you have. So it's a balance between credit cards, it might be loans, it might be a car loan, it might be a personal loan. What is your balance? We want to make sure it's a healthy mix of credit. And lastly, at a 10% is opening new credit lines. How often is a person applying for credit? So let's go ahead and take it to the next step. Let's talk about what is a good credit score. You'll be happy to know that about 2/3 of the American population has a good or better credit score. So that's good news. Next week's video, we're going to break down how you can work on building even healthier credit, but let's talk about some of the highlights. The actual score is a numerical rating that measures the likelihood of a person to pay off their debts. So obviously, the more a person is paying off their debts, then a lender sees that as a lower risk borrower. So the higher the score, the lower your risk. The minimum credit score for qualifying for a mortgage is 580. So one thing that borrowers need to think about is the higher the credit score, the lower the interest rate. So in next week's clip, we're going to talk about all the differences between the types of levels of credit, how you can build your credit, and how you can continue to boost your credit score so you can take advantage of additional incentives when you're trying to buy a home. We look forward to the opportunity to talk to you and your borrowers about their situation and how we can help in boosting their credit score.